I've been trading for 6 years, I've made over $1 million and I've received over 217 prop firm payouts. And in this video, I'm going to go over the 7 rules that I've learned over the years with all of the highs and lows from trading, so that by the end you don't make the same mistakes that I did. The rule number 1 is that if I don't know the direction of the market, then I am not going to trade. What used to happen a lot that kept me break even and even unprofitable as a trader is that I would execute on the plan very flawlessly. I was entering on the right trades, I had the right risk management, but for some reason I always would give my profits back, all of them, all the time, and I didn't know why. And this is when I started to understand that I used to treat every single trading day as a trading day, until I understood that most of your thesis should be happening on the daily chart, because if the daily chart is very obvious on where it wants to go, then trading the lower time frames is going to be way easier. So I went through all of my losing streaks and I noticed every single time that I was losing 3, 4, 5 trades in a row, it was happening while the market was ranging, and that was completely destroying my trading. And so now I don't need to trade every single day. If when I do my forecast, I do not have a clear direction in which I want to execute on, then I just sit out for the day. Because as a trader, if you don't know exactly where the market is headed, then there is no point in trading, because direction is the foundation of everything trading related. The second rule that I follow every single day, and I do not trade if I don't follow this rule, because it's one of the biggest pillars of trading profitability, is that I forecast every day. It's the one process that I follow religiously, and I'm going to tell you how to do it so effortlessly. For a long time, I thought that forecasting was extremely boring. I always thought, no, I know exactly where the market is going. Doesn't really matter. Now, if it hits here, probably I'll take a trade. That's the problem. As traders, we know exactly what we have to execute on, right? But as traders, we have to be as unemotional as possible. And every single time that you start having a strong bias in the market, this is where your emotions come into play. And that's where you start entering forced trades. That's when you start having fear of missing out. That's when all of these things happen. So forecasting after your session has started is a recipe for failure. Why? Because now you have emotions attached to the price section. Yet if you forecast 15 minutes before your session, which is exactly what I do every single day, then you are able to look at price unemotionally and just think, yep, I think the market is going bullish. If that is the case, this is the level that I want to execute from, and this is the level that I want to execute from. If the market doesn't reach any of these levels, either I don't trade or I look for another way to execute, which you also forecast. And you'll notice that if you start doing this every single day, the one process that you do every single day, your results are going to change drastically. And now here's an extra tip, and I learned this from so many professional athletes, is that you actually want to record yourself every single day forecasting exactly what you want from the market. Now, why do I say that I learned this from athletes? You know, athletes are always reviewing what they can improve by reading the tape. And I started applying that into my trading by always being able to review how I was feeling before I forecast. Recording your forecast is absolutely a game changer, because now you are able to speak out loud and not only just write down what you want to see from the market. And we know that the spoken word is way more powerful than the written word. So I want you to record it. And here's how to make it extremely easy. On TradingView, you go to the top right corner and you click on publish. This below that has record video idea. And then you are able to actually record your browser, in which then uploads to TradingView. This is something that I used to do for a long time, and I still do to this day. Forecasting every single day and recording your forecast is an absolute game changer, and I will stick to it for the rest of my trading. Rule number 3 is lock in that payout. Right now, with social media and prop firms gaining such mainstream attention, you always see this over and over again. Traders getting $10,000, $20,000, $50,000, $1 million, $2 million, and you think, this is the new normal. And then you start looking at your account and you're like, I mean, $200 profit, it's not even worth it to take out. But here's what traders don't understand. Maybe right now, my $10,000 payout versus your $300 payout is going to change your life the same exact way. But you look at my payout and you compare just the amount and you think, oh, no, this is not worth it. But let me ask you this. If you were to now make an extra $500 every single week from trading and you were to lock in that payout. Wouldn't that already make life so much easier? And that is really the goal with trading. I want you to lock in the payout for two reasons. One, the amount of money is going to compound. You'll see that $100 turns to $200, to $300, to $500 a week, to $1,000 a week, to $5,000 a week. It compounds as you become a better trader, as you are locking in those payouts, as you are able to put more money into prop firms, get bigger accounts, and slowly but surely you will build up to these bigger payouts. But don't try to go from $100 to $10,000 in payouts. It's not realistic and it incurs a lot of stress and takes a lot of risk. So one of the rules that I've made for myself and I follow religiously, and that's what has allowed me to make so much money from trading and from prop firms. On average, I have a 10x return on every single prop firm that I put money into, is that I always lock in the payout. Because let me just tell you one last thing about this rule. Prop firms want you to fail. Don't be the person that is trying to go for that bigger payout and bigger payout and bigger payout, because that's exactly what they want you to do, because they know you will blow up. So that's why you have to lock in that payout. Doesn't matter if it's $100, $200, $1,000. It's money that you just made from trading, and if you just wait a week or two, you can put into your bank account. And that's the most beautiful thing about prop firms. Rule number 4, I stopped looking at the P&L and I started looking at structure. Market structure is the most important way for you to approach your trading, be that through entries, be that through take profits, be that through stop losses. But I see a lot of traders, and I used to do this too. Oh, I don't want to lose 0.1 because that means that I lost money. But in reality, it's very, very rare the times at which I put my stop losses at break even. Why? Because break even very rarely is aligned with the market structure. So I only move my stops based on market structure and key levels on the chart. And I've learned this the hard way with so many times. Trades coming back to my break even, tagging me out, and then just flying to the take profit. Why is that? It's because the market is going in one specific direction. And if you're trying to squeeze your trade so you don't lose money because you're fearful of losing minus 0.1 or minus 0.3, then you are squeezing your trade, you get tagged out, the market is still perfectly in line with the direction that you forecasted, and then it just goes after it tags you out. And since I've learned that the hard way, just know structure and direction are the one thing that matters. If you focus on structure and direction, stops and entries are going to be extremely obvious. Don't look at your P&L anymore. This takes me to rule number 5, and that is that when you are in drawdown, do not reduce your risk, reduce your trade frequency. I've seen the tip of reducing the amount you risk when you are in drawdown for way too long, and frankly, I've been part of those people. I've been part of the people that go into 3% drawdown and all of a sudden they're risking 0.25%. That makes absolutely no sense, because you go into drawdown and by you reducing the risk, it just increases the amount of time that you're going to be stuck in drawdown. So the next winning streak that you have doesn't even get you out of drawdown because you were risking so little. So the one thing you have to do as a trader, if you ever want to become profitable over the long term, is understand that once you get into drawdown, you need to reduce your trade frequency. And why are you reducing the trade frequency? It's because you're focusing on higher probability setups. And you know what those setups are. You know that there's not an A+ setup every single week, 5 times a week. You know that an A+ setup comes maybe once or twice a week. And so instead of taking 5 trades per week, you cut it down into 2. But since those are so high probability, within a week, you're out of drawdown. And that is the most amazing part of trading. And that is why last year, my biggest losing streak was 5 trades, which my maximum drawdown was -3, and I got out of that drawdown within 1 week. Why? Because I knew what trades to focus on, and I knew not to cut risk. Cut my trade frequency by increasing the probability of the trades that I was taking. And this has completely changed my trading. Just as point number 6, which I call my risk management non-negotiables. Those are that if I ever feel emotional about a session, about price, I move on with my day and I do not trade. I need to do my forecast in a very calm state of mind. If I notice that I'm very uptight and I just want to trade, I step away from the charts. Why? Because tomorrow there will be more trades. If not tomorrow, then the next day. It doesn't matter. Risk management non-negotiable number 2 is that I never over risk. I never take more than 2 losses in one day because I know that the third trade that is coming is already going to be emotional. In the fourth also, in the fifth also. And I know so many traders are going to say, well, Kimmel, what if the third trade is the high probability trade? It doesn't matter because traders look back and they think, oh my God, if I took this third trade, it would have played out, but they never play out the scenario in their mind of if the third trade would have been a loss and that would have taken to the fourth and the fifth and the sixth. You know this because you've had this already. You've been in a trading session where you take one loss, you're already a little bit emotional, then you wait for the second one, now you're more emotional, and you take the third and the fourth and the fifth, and you only stop once the account is blown. So that's why after 2 trades in one day, I'm out. Risk management negotiable number 3 is that I keep my trade frequency low. Why? Because I want to make sure that I optimize to higher probability trades so I can push more size into the trades that I'm taking, right? If I'm taking 20 trades a week, do you really think that I would be comfortable with risking $5,000 per trade? Obviously not, because that means a total risk exposure of $100,000 per week. While if I reduce my trade frequency into 2, 3, 4 trades per week, all of a sudden my risk exposure reduces by 80%. And that is one of the things that I live by, is focus on high probability trades with more size. And rule number 7 is don't touch your trades. You'll notice that every single thing we do after we execute on a position usually is the wrong thing to do. Why? Because before we enter in a trade, we are very calm. We know exactly where we want the market to move. But once we are in a position, now we are betting on this idea that the market is more likely to move in this direction than it is to move in this direction. And if it moves against us, then we are wrong. And so every single thing that we do after we execute in a position, be it managing, be it moving your take profit, moving your stop losses, tends to be emotional. And I know that my best performance comes when I just set my position, where I've picked the direction, I've picked my validation levels, I've picked my take profit levels, and I just let it be. And I've learned this the hard way of getting tagged out multiple times just to see the market go to the exact level that I predicted before the session opened. And so sometimes the best thing is to do absolutely nothing. Just leave your stops, stop micromanaging your positions, have your take profits, and move on with your day. And you'll see that if you follow these 7 rules, the likelihood of you becoming profitable increases dramatically. With that being said, let me know what your favorite rule is down in the comments. If you want to master trading direction, just go to mastertradingdirection.com or use the link in the description where I have a full free course on direction, so you are able to forecast it every single day consistently. If you want a full mentorship, then check the first link in the description for Funded Trading Blueprint, where you are guaranteed to get funded in 90 days. And if you want to check out the best prop firm, then check out Funded Next with code Kimmel in CFDs or code KT when you are doing with futures to get applied the best discount code. With that being said, I'll see you in the next one. Peace.